So I guess we're ready to go, and hopefully you've got the slides, but if not, we'll do the best we can today. Everything's coming off the slide. So as far as I want you to read the book. The book's going to help you with the homework. The book's definitely going to help you with the exams. But what I'm going to emphasize is that if I don't cover it in class, it's not going to be on the exam. So whatever we cover in class is going to be testable material. All right, so today we're going to look at Chapter 1. And in Chapter 1, we have several learning objectives. And what I've done to make the course hopefully a little more interesting, which is kind of an oxymoron with accounting, I guess, but to make the course a little bit more interesting, I broke the course up into small modules. The small modules are built off learning objectives. It's very easy to do with this textbook, so learning objectives are discrete. So the first objective is to explain to you what accounting is all about. A lot of you, anyone here have accounting in high school? Because a lot of people do. Okay. Could be an advantage, could be a disadvantage. The disadvantage is if you think you know it and don't put the time in. The advantage is you'll have at least some depth of the material. So we want to know what accounting is and how accounting information is used. All right, so first, accounting, of course, is nothing more than an information system that measures and communicates financial data to users, various users within the environment in which accounting operates. And you notice that you have both internal and external users. External users are really the focus of this course, which is financial accounting. The next course would be dealing with internal users of financial information. So, to me, the primary importance, we'll spend a little bit of time with respect to the internal users, but our goal is to make sure you understand the information that is prepared and distributed, disseminated out to the market. Now, for us, the primary importance of this external information is we want to be able to be sure that users of the financial statements can make rational economic decisions. I'm looking at this from a very broad macro perspective, and to try to put accounting into a position where you understand that it's important is that it is going to drive the market. It's going to direct capital flows to their most productive uses. When you look at a company's financial statements, you're going to be determining whether or not you should buy the stock of that company, whether lending should be done, should you lend money to this company or not, should you sell your investment. Right now, what would be an example of a company where you may not want to invest? Did you think of any company that might be a little bit of a problem right now? Everyone's got a cell phone, right? What brand do you have? Everyone's got Verizon, everyone's got Apple. Anyone have a BlackBerry? All right, one, there's your problem. And I have one too. All right, so Research in Motion, right now, it's a Canadian company. They are, in fact, thinking about selling off the BlackBerry product. There's got to be a niche somewhere. I've got nothing but Apple products in my house. I've got, iPad and all this. I can't sync the BlackBerry. The only problem is I can't type that on an iPhone. So that's the only thing holding me back, but I'm the next one to go. So before you know it, I don't have a BlackBerry either. But that's an example of a company, when you read their financials, you may not want to buy the stock of the company. Where would you, what's a new industry? Is there anyone a new industry you want to invest? Right, healthcare, of course. Whole bunch of people out there, right? So you got to have medication. Yep. Solar. Energy, electric vehicles, solar power. Exactly. Yep. Technology. You said. Wind. Yeah. Any alternative. Exactly. Energy sources. Alternative sources of energy. Exactly. So you would find out whether or not it is worthwhile to make that investment if you had the financial information that's prepared for external reporting. Now, financial accounting, of course, this course will focus on providing that information. Financial position, which includes the assets of the company, what are its obligations, its results of operations, which is its earnings, and its cash flows. So what we're going to look at is financial position, which includes assets and obligations. We're going to look at, I'm going to put the this up on the board if we can make it large enough to see it, unless I switch to the dot cam. So financial position. Operations will be earnings. Earnings, or you have a loss, and of course, cash flow. And that information is provided to external stakeholders. Now, if you look at the list of external stakeholders, you notice that there's a wide spectrum of financial statement users. You've got investors, creditors, the government, insurance companies, and the list goes on and on. So the problem that we're going to have as accountants or anyone that's issuing financial information, don't forget, if you're managing the company, if you're the CFO, if you're dealing with the company internally and you have to issue statements, you have to realize that they're going out there to a wide spectrum of users. And for that reason, we have what are known as general purpose financial statements. We try to best satisfy the needs of a wide spectrum of users. We don't satisfy specific needs. Now, I may want to know something about, a cash balance for a particular company. I can't get that information. I'm going to get general information about the company, but I'm not going to get too many of the specifics. So we call these statements general purpose, and they are designed to satisfy as many people as possible at the least possible cost. And later in the chapter, in fact, the last learning objective, we're going to look at these general purpose financial statements. Now, if you were inside a company, I'll show you this in a minute, internally you can make up information in any form you want. So if you're a manager, you can get information in any form you want. I can't go out, and looking at this room, you got 250 people in here. I can't ask everybody what they'd like to see about each company. I'm just going to give you a general set of statements and try to satisfy as many as I possibly can at the least cost. It's not going to work if you want specific information. But internally, if you were inside the company, you could demand any information you want. So if you're a manager, you could ask an employee to develop a set of numbers for you that you can use for a particular decision. So for example, you may want to know what everybody is making in terms of sales commissions. You're not going to find that in an external set of financial statements. I might give you the total of sales commissions, but I'm not going to tell you what each employee is making. If you wanted to know what each employee is making, you would have to be working inside the company. So these are external statements, and they will be general purpose in their nature. Now, the other issue, and this is what makes, if you do wind up majoring in accounting, the bigger problem is all of these rules. And a lot of people tell me, you go to a Labor Day barbecue, oh, you know what, my son is good in math, so he wants to major in accounting. And I told him, if he's good in math, don't major in accounting, because the toughest thing we do is divide. It's not math. It's a lot of economics. It's a lot of analysis that goes on, and it's a lot of rules. And these rules are almost like law or code or business law. So you have to understand the principles and the regulations that go along with it. So these accounting rules it's a fixed set of rules. So if I'm going to issue statements to external users, I have to have a set of standards that is well known to all of these users. And those are known as generally accepted accounting principles, or GAAP. So you'll see the terminology. When you look at the generally accepted accounting principles, you'll see the term GAAP. Now, this set of standards has been developed by several bodies. We'll talk about them in just a minute. This first one, don't have to write this down because I have it later, Financial Accounting Standards Board, the Securities and Exchange Commission, and the International Accounting Standards Board. I'll get to that in a moment, but the point is, since the statements are going out to 250 plus people, I've got to make sure those standards are reviewed and they are accomplishing what we want to accomplish. That the numbers you get, that the values you see for assets and obligations, that the earnings that you get are as correct as they can be. They're not going to be 100% correct, but correct as they can be. Now, the opposite of external accounting is internal, and we'll do some of that. So let's put this in perspective. External accounting is good for, of course, accounting majors, finance majors need to know that as well, but for managerial accounting or internal users of financial statements, that's where you get involved with the use of accounting information for marketing. How do you know how to price a product? What about budgeting? How much should you invest in a new product development? How much should you invest in research and development? So from a marketing perspective, supply chain management, that's where you use internal accounting. That's where we use accounting to make decisions on a day-to-day basis, long-range planning, and budgeting as well. All right, now these are still decision makers, but they're internal to the company. And as I said, you're not going to worry about external users. And you notice the word here, you can get reports that are customized. So if every one of you, 250 some odd students, if every one of you working for different companies, you can demand a different report specifically designed to meet your needs. That's because it's internal and it's a special purpose report. Now, the managers are getting information, and there's no real set rules on how you could put this information together. For example, you could use a forecast in your numbers. You could have someone do a budget for you. I can't use a forecast to you as an external stockholder. I can't take a guess or forecast what my earnings are going to be. I've got to give you the numbers that are historically based. But internally, I can make that forecast. I can make those projections. And again, there's no fixed rules that you're going to have to follow with respect to internal or management. So to summarize, this is coming from the book. To summarize, external users, financial accounting. For this course, we're going to issue general purpose financial statements. The general purpose financial statements are subject to a fixed set of rules, and these are the types of decisions you'd make. Is the business profitable? Should I buy the stock of Research in Motion, BlackBerry? Should I lend money to this company? General Motors was bankrupt. What happened to their stock? What happened to their debt? You'd find that out through, or at least the information, you'd find that out through the financial statements. Internally, no fixed set of rules, specific statements. And those specific statements could help you with capital investments, with budgeting, and any other forecast you'd like to make. And again, the difference is, and you'll see the difference in courses, what I like about the internal decision makers, or from the standpoint of marketing and supply chain, you can think about product pricing. You could think about test marketing a product. And you need accounting information for that as well, in terms of what is it going to cost you to make the product. And cost structure, coming up with price. What are you going to charge for a product? It's going to depend on what it's going to cost you to make that product. Can you make that product competitive? If you're going to make an Apple always had trouble years ago, before your time, selling products. That's why Apple stores were put into place, because Steve Jobs did not want an Apple computer sitting between a Dell and an IBM, or now Lenovo computer, because they're way overpriced. An Apple computer, you can get a Dell for like $600, and the least you're going to spend for an Apple is $1,000. So in order to differentiate his product, he decided to move it out of retail stores. Never wanted to have it there. So again, can you sell it for more? Well, yeah, but Apple had to determine whether or not they wanted to price it that high, and it depended on their cost. Their cost is higher because of differences in quality, differences in marketing as well. So again, you'll find that in the next course. This course, we look at Apple's bottom line. We look at Apple's net income. We determine whether or not we should continue to invest in Apple stock. All right, so are there any questions now with the first aspect, the first issue regarding accounting? Yes? Yeah, that's right. Yeah. Everything about the company. It really permeates almost every part of a company. those decisions, whether or not you're going to be profitable or not, will depend on other aspects, but you need the cost data in order to make those decisions. No. For example, I can tell you that would you invest in research? How much did you invest in research? Okay, so let's say you know that the research is going to benefit. What if I told you that research is going to drag down your bottom line? It's going to impact your earnings negatively. Would that possibly reduce the amount you're going to spend? Short term. It depends. It's going to depend. It's going to depend. So you could influence. The other thing you can influence, I mean, obviously you can't change. Accounting is not going to change how I make a product, but it can tell a manager, if you make it a certain way, this is what your profit margin is going to be. That's right. Yeah, it's part of it. Yeah. Give you a perfect example. When you're pricing out let's just say when you're pricing out a product, if you're going to let's say you're able to set the price. Let's say you're able to set the price. You've got like Apple can pretty much set its price. Then it doesn't have to worry about how much amount its cost, because it can, in a way, just say, I want to make 40% on this product, and then it could design the product in such a way to make the 40%. The other way, when you're a price taker, and you have to, like, for instance, Dell has to price at, or Acer computer has to price at $800, they've got to be sure that their cost is as low as possible. And that's going to be part of the process. How much labor do you use? How much of a labor-intensive process do you use? Yeah, that's right. If you go back to the first slide, accounting is an information system that is used to make various decisions. Yeah, good points, good questions. All right, any others? Okay. All right, now, talking about, just so you know, not that you're going to be employed as accounting, but you should know a couple of things about what you can do in accounting. Obviously, you can be in education, government, you can work in any type of businesses. You're usually a CPA. You don't have to be. CPAs are generally employed in public accounting firms, and I think the purpose here is just not to give you a sort of a dog and pony show to get you to major in accounting, but really to make sure you understand what types of services are provided. Do you have to get involved with this sometimes? Yeah. As a manager, you may have to hire a CPA firm to do some work for you. And if not, you may want to do that work internally. So let's see how this would work. Public accounting. Public accounting is one arm of the profession, and they provide services. They are independent of the company. So, for example, Apple has their own auditors. Their auditors or their accountants could be KPMG. It could be Deloitte. It could be PricewaterhouseCoopers. If you don't know who KPMG is, I think they audit the New Jersey Lottery or something. So you'll see when they pick the numbers, they say these numbers have been audited by KPMG. These are public accounting firms. Cohn Resnick is another local firm in Roseland, New Jersey. They provide auditing services, tax, and advisory. The accounting firm has to be independent of the company. So the CPA firm does not work for Apple. The CPA firm does not work for General Electric. It does not work for Samsung. These are companies that are hired, and they are brought in to do various work for the company. Now, the audit or advisory services, you have to, if you're filing with the Securities and Exchange Commission, if your stock trades on the New York Stock Exchange, you have to have an audited statement. This is known as assurance or auditing services. What the accountants do is they come in and they will examine, not every transaction, but they examine a sample of events and transactions to ensure that the financial position, so let's look back here, the assets and liabilities or obligations, the earnings and the operations, and the cash flows of the company are in fact fairly presented. Now what does that mean, fair presentation? Anyone know? Are the numbers exact? No. There are errors, but the errors are not significant. the errors are not material. When we use the word material, we don't mean fabric or paper or something like that. When we say material in accounting, we mean that they are significant. So we're saying here, fair presentation means that it is free from material error. So there are errors, but they're not significant. They're not significant errors. We know they're not exact. And we express an opinion. And the opinion is issued to shareholders and the board of directors of the company. And that opinion will say that we've examined the financial position, we've examined the results of operations and the cash flows of the company, and in our opinion, the statements present fairly. And that's all we give you, is limited assurance that the statements are fairly presented. They're not exact, they're not accurate, but they are a fair presentation. Now, we also do some tax work, prepare tax returns, do tax planning, and represent clients at the IRS, and advisory services. Advisory services, by the way, if you ever want, if you want to, advisory services are opened up to. We had a guy in our MBA program in accounting who jumped to a private company to do supply chain because they're intimately related. In accounting, we learn a lot about, we talked before about information systems, about delivery systems, et cetera, throughout the company. So you could work for a public accounting firm or a private company, but you could work in public accounting and do advisory services. You build information systems, computer systems, you deal with information technology, and you give management advice. So public accounting firms will do all of that as well. And of course, the government, finally, I guess, or corporate rather, sorry, corporate accounting is where you work inside the company. So now you are a general accountant or a controller or a financial analyst or a systems analyst inside the company, and you don't work for a public accounting firm, but you work for the company directly. So you work inside Apple, Toyota, or the National Football League. And yes, the National Football League has accountants. You have to look at contracts, salary caps. In fact, you sometimes think about, I know you don't think of it as that, important, but the accountants could in fact be the most valuable players on Super Bowl winning teams because they're the ones that structure contracts to make sure that the salary caps are not exceeded, and they defer compensation. They do lots of things to the athletes' contracts to make sure they meet the rules of the salary cap and at the same time satisfy the compensation contracts they have with their employees. So that's internal. And again, you could have, I don't know too many people that have this, but you could be a CMA as well. And then, of course, you could also work for the government, the Internal Revenue, you could work for IRS and the Securities and Exchange Commission. All right. Any questions on the first objective? Our first objective today was just to give you an overview of accounting, what it's all about, and what types of professions they have. Any other questions? I'm going to get to some questions from you in a second. So now, let's go to the next page, which is the first question. And if you have a clicker, and if it's registered, we're going to try this. It may not work, but we'll try it. The first question said that the wide spectrum of financial statement users results in issuing general purpose financial statements. A lot of these are going to be easy, so just sort of testing the waters a little bit here. So what I would do, and I have the remote to do this, I'm going to store it, clicker, and there it is. So now, what I would ask you to do is, if you have your clicker, the time here, I normally give you like a minute to do this, and we're simulating next week when this really counts. I give you a minute because I'm assuming that you've looked at this before, and I realize that someone could be looking at your answer next to you. We'll talk about how this is going to be graded in a second. But press A if you think that's true, and B if you think that's false. So let's see if anyone's clicking in. 25, 26. All right. And the purpose, by the way, is not only to take attendance. In fact, that's just a side effect. The purpose is to initiate discussion, particularly when the questions are, when your answers are incorrect. When your answers are incorrect, we're going to discuss them. Even when they're correct, we'll go over it briefly, but if everyone answers this question wrong, I'm going to go back and reteach it. And that's the purpose, because I want to make sure you learn. And the way you're going to learn is, if I said something, no one paid attention, or no one understood, it's my fault, we'll find out. Okay, and there it is. And the answer is A. It's true. Because we have so many different users, we can't have specific purpose reports. We have to have general purpose reports to satisfy all of those users. So the answer is A. I'm not going to click it because I don't want to grade it, but if I go down here, if you're looking at the screen, if I click this, it would ask me to pick the right answer. I'm not going to do that because I don't want this graded. Okay. So now, if you pick B, again, I know the question didn't say external users, but again, the variety of people's interest, the variety of users is going to trigger the need to have general purpose information. Okay, so the answer to that is A. All right, let's try another one. Internal and external uses of financial information use these data to make rational economic decisions. So, is the information useful for both internal and external users of financial information? And I'm glad to see we got about 40 people with clickers. That's a good number for the first day. A is true, and B is false. Both internal and external users of financial information. Yeah, these are easy. I know that. So, I think. All right. Okay, it's also good for you to get used to using these things. So, everybody's in. I'm just going to let this thing run down, give you the full effect. Okay, there we go. All right, so now that's interesting. It's getting to sort of like where I need to talk about this a little bit. The answer is A, by the way. And if you put B, let me explain why A is correct. A is correct because external users predominantly will use financial information to make investment and credit decisions. Again, I'm looking at the financial statements of Research in Motion, the manufacturer of BlackBerry. I look at their financial statements, their earnings are declining. Their market share is declining. Their profit margins are declining. So, again, do I invest in the company? Do I expect a turnaround? There's other information in the annual report as well. There's information about footnotes, which we didn't talk about yet, which might explain the company's plan to sell the business or to merge with somebody else. With that said, I can invest in the company or not. Credit, I can lend to the company or maybe not. And if I lend to the company, if I suspect any potential problems, what happens? I raise the interest rate. They're not going to borrow at cheap rates if I think they're not going to do that well. So I'll raise the interest rate. Now, internally, how do I use information internally? We just talked about this before. How do internal, what decisions are they going to make? Yeah, product pricing, capital investment, right? So, it's not only pricing products. How do you know if you're going to invest in a new plant? You have to think about demand for the product, but you also have to think about the cost of running the plant, the investment, the interest that you borrow. So there's a lot of decisions, and we do this in managerial accounting. In management accounting, in 204, we get involved with whether or not you should make a capital investment. We also do that in finance. There's lots of overlap. So, in finance, you might take a course in managerial economics. There's also corporate finance. So there's a great deal of overlap. So the answer is A. The answer is A, that the information is used by decision makers in both internal and external context. Okay. All right, so now, this one, I know we just talked about this, should be fresh in your mind. When an independent CPA examines the financial statements of a client, he or she expresses an opinion on the statements as to the correctness of the presentation. All right, so again, this one, I hope it's easy. And everyone clicking in at a rapid pace. In. More people. People are surfacing. Okay. All right, so I'm going to, oh, there's more. Wait a minute. Where do these clickers come from? So you have 50 people in. Let's see. Oh. Hey, I just put this away. I mean, I gotta go back. All right, look. Let's go back to the question. It says correctness of the presentation. Well, no, it's false. I mean, we do not. Yeah, it's B. It's B. We do not tell you that the statements are correct. We say they are fairly presented. That's a very sophisticated way of dancing around the statement that the statements are, or at least the comment that the statements present fairly means that they are free from material error. Free from material error. So make sure you get that when you look at the statement. So if I'm giving you an opinion on the financial position, operating results, and the cash flows of the company, that opinion says the statements are free from material error. And that's what we mean by fair presentation. Yep. Okay. It's not correct, yes. The presentation. No, the presentation will include the assets, the financial position, the statement of operations, the statement of cash flows, footnotes, and other disclosures. So the entire disclosure. For example, what if you looked at Verizon's financial statements, let's say the first quarter or second quarter, they might have said they're thinking about buying their interests, from Vodafone. That might have been in the report. It didn't happen yet, so it's not in any of the statements, but it's there. Okay. So again, if you put down that the statements are correct, anyone have any doubt that all, by the way, I guess the frightening thing for me is that if I was a partner and I'm signing off on that, and we have a lot of controls, obviously. I think the accounting firms do a real good job. But think about it for a minute. If I go into Apple, I may take a sample of 70 invoices, and if all those 70 are correct, I assume the other 7,000 are correct. We use statistical sampling. We sample statistically. We do not look at every transaction. So we can't say it's correct because we haven't looked at everything. We can't, it's impossible for us to look at everything. Now, we are getting to the point where auditing is becoming more and more automated, and it's becoming more and more possible with technology to look at a larger number of transactions electronically through a continuous auditing process. But for the most part, the basic auditing is a sampling approach. It's a sample technique. All right, so any other questions or any doubts as to the presentation? Okay. All right, so this gives you an idea. We're going to go on to the second module, but this gives you an idea of the way the class will be run. And you notice that you start getting a little bit, every once in a while I'm going to have to, get the noise down. This is, if you go online and you look at large lecture classes, that's the way it's run. People are clicking in, people are talking, that's fine. But then we have to bring it down a bit to get to the Okay. Let's go to the next. All right. What we want to do now is spend a little bit more time describing some of these organizations that we mentioned before, the Securities and Exchange Commission. And again, this is more business knowledge, not necessarily accounting knowledge. And on top of that, we want to look a little bit at some of the concepts that underlie the financial statements. And what this book does is it will intersperse a conceptual or a concept or an assumption from time to time. All right, so what we're going to look at, and again, right now, we're totally internal accounting. You have to wait for 204 for management accounting. So we're not going to be playing around with internal statements. It's all external. All right, so here, in summary, are the primary boards that handle financial accounting. First of all, let me just tell you that the Securities and Exchange Commission and the Financial Accounting Standards Board work together. And it's a very interesting relationship, and it's somewhat confusing because the Securities and Exchange Commission has always been empowered to dictate standards in the United States for accounting and for financial reporting, but they allowed the private sector to handle most of this. So the Financial Accounting Standards Board is the board in the United States that's privately funded that creates the accounting standards. And the accounting standards apply to all companies. And when we say all companies here, we mean, so when you look at the FASB, we mean that the companies are either privately held or public companies. The SEC handles public companies only. Now, what does that mean? What does it mean to be a public company? Yeah. If your securities trade on a stock exchange, you are regulated by the Securities and Exchange Commission. So, when we say a public company, it could be New York Stock Exchange, it could be Philadelphia Stock Exchange. Private companies are just the opposite. Private company does not trade. By the way, it keeps going back and forth, but I think that Ford is still a private company. I mean, a large company like that. So there's another, and by the way, accounting firms, if you're interested, do have what are called private client services. So, anyone ever hear of Goya, the food company? It's a family business. They're huge. It's a family business. So, that is not a publicly traded entity. You cannot get the financial statements of Goya. Those financial statements are internally generated. Those go out to the family members, and if they want to borrow money, they will go ahead and give it to the bank. But you can't get those statements. But I can get the statements of a publicly traded company. If that stock is traded on the New York Stock Exchange or any stock exchange, I can get those financial statements. And again, you have to follow the rules of the SEC. Now I'm going to tell you, the statements and the rules are 99% the same. You just get a lot more information in the SEC document. The SEC documents give you a lot more information. They'll give you the age of the directors, their salaries. You'll get the location of their plant, the square footage of their plant, like a lot of detail. So the SEC documents are much, much more detailed. But again, the rules, the accounting will be very, very similar. Now, to give you some more background on this, you look at the SEC. Historically, the SEC was created right after the stock market crashed in 1929. And again, this is just background, general business background for you. The stock market crashed 1929, and the financial statements at that time, interestingly, were inconsistent and really incomplete. So some companies would give you a statement on financial position, but nothing else. Other companies would give you a statement of operations, but nothing else. Others would give you disclosures. Others would give you everything. So when I picked up some statements from 1920, and you never know what you're going to find. So there are inconsistencies and incomplete information. And therefore, in 1934, or prior to 34, there was no board or body to regulate, so the SEC was in fact created. So the SEC, this one, yeah, I think I did. The SEC definitely, as I said, when they were in place, they delegated the standard-setting authority to the National Accounting Standards Board, and they still are involved because they still have the authority to do so. Okay. The SEC requires, as we said, that publicly traded companies will have audited financial statements by a CPA firm, and make sure this is something you need to know. An annual form is the 10K, the 10Q is the quarterly. So right now, at the end of September, for the third quarter, companies would be filing a quarterly report. The annual report comes out, obviously, at the end of the year. And these are the forms that you have to file. Again, the Form 10K, the annual has to be audited. The quarterly is not audited. So I can tell you that it's, you may find that strange, but if you look at the 10K, the 10Q, the quarterlies are not audited. So it's kind of like let the buyer beware when you look at those. You have to be kind of careful, but they're useful information nonetheless. And you talk about correctness. If you think the annual report has a problem without being, with not being precise, 10Qs are even more subject to estimation. Because don't forget, if you want the information to be useful, you have to have it as soon as possible. Because right now, if I wanted to invest in Apple, the only information I have, if I didn't have the quarterlies, is last year's annual report. So I'd have to wait until the end of 2013 to get that annual report. So the quarterly report provides me with useful information on a timely basis, on a more timely basis. Okay? Although it's not audited, it does provide me with useful information. Yeah. Yeah, in other words, well, by the way, any irregularities are picked up and either prosecuted or corrected. So generally what will happen is when you file with the SEC, that's the government, and that's where you can get some prosecution. The FASB is not the government, so they don't get involved in any of the prosecutions. You don't file with the FASB, you file with the SEC. The rules, the accounting rules could come from either or both, but the actual filing goes from the Securities and Exchange Commission. Right. You have to, when I was auditing, I had to review the quarterlies, and we still do the same thing today, for what we call a reasonableness. So we look at the numbers, if they look reasonable, we let them go. But the one thing to remember is that the quarterly report is stamped, unaudited, so it's let the buyer beware. You got a warning on there, you know that they're not audited. So if you rely on that, we're already telling you that it's not 100%, as good as the annual. Yeah, that was part of it too. The Enron was part of it. What happens, by the way, what happens with the quarterly statements, which is pretty interesting, you could take the first, second, and third quarter and always find a very easy way to forecast. The fourth quarter is all over the place. Why? Because you got to catch up to reality. You got to make all the adjustments to bring all these estimates to actual. And we do use a lot of estimates and a lot of judgment in accounting, but a lot more in the quarterlies. So again, you've got to be able to realize again that these are not audited, and you know they're there, and it's stamped unaudited, so the reader definitely knows that in fact is the case. Okay. Any other questions? Those were good questions. Any others? Yeah. Securities and Exchange Commission is a government agency that sets standards along with the Financial Accounting Standards Board. FAS, they do it together. No, the FASB is a private agency. So the way it worked was that in 1934, when the SEC was created, 33-34, the SEC could have, actually the government could have controlled accounting in the United States. They had the option to do so, which is true in a lot of countries. They decided not to do that. They decided to oversee it and let the FASB as a private agency do it itself. There were other boards that I'll mention, but over the history of accounting standard setting, the Financial Accounting Standards Board, or the private agency, was given the authority by the SEC. Yeah. In fact, the Securities and Exchange Commission could veto or overrule what the FASB does. So they watch carefully. They will nudge and push the FASB to jump on something if they don't early enough. But there's a good working relationship between the two. No, because if they're not going to worry too much about you if you're privately held. So privately held companies, there's something known as big gap, little gap. So if you're a private, like Goya is a big company, but they can follow little gap. There are certain disclosures they don't have to make. There are certain rules they don't have to follow because who's getting the statements? The family. Yeah, well, tax is different. I'm going to get to that in a second. And I'm glad you mentioned tax because it's going to be completely different. Okay. Any other questions? All right. Now, again, we have the FASB, and the FASB is the standard setting board in the United States for public and private companies. It's been around for quite a while. Again, it's made up of 7 members. I can tell you that the FASB has members from finance, from management. It has a very diverse body, and they will set standards. Now, again, they've worked with the SEC, so if you didn't hear that discussion, it was a good question about the SEC's role. The SEC will oversee rules that are used for publicly traded companies, but don't forget the FASB is going to handle both public and private companies. Right? So again, there could be some differences there. All right, and one last thing on standard setting. A lot of you may have heard that there was a very large movement to have conformity worldwide with accounting standards. Why would that be needed? Why would we need to have global accounting? Someone else, yeah. Yeah, so that cross-border investing would be made easier. So if I needed to file, years ago, if the first time that Daimler-Benz, Mercedes, the parent company that makes the Mercedes, when they wanted to file in the New York Stock Exchange, they had to fill out a form that was about this high that reconciled German GAAP to US GAAP. And that's what we want to avoid. Now, we're getting closer. Don't know if it's going to happen because there's still lots of disagreement about the convergence. But we're getting closer with our standards. Every country had their own GAAP standards, and what we're trying to do is minimize that. Now, right now, most of the world, except for the United States, is on International Financial Accounting Standards, IFRS. Most of the world, except for the U.S. Now, whether or not we converge or not, needs to be seen. Those dates, 2016, those keep jumping all over the place, so we're not sure. If that happens, you'll find out that the FASB, the SEC, and the international standards they're similar, but there are certain nuances. I will tell you that there's a lot more judgment used in international standards. The U.S. standards are more strict in terms of numerical thresholds and rules. There are more rules here. There are more concepts. So it's a lot more judgment under IFRS. Now, nonetheless, all of these organizations issue what I said before, generally accepted accounting principles. So now let's define GAAP. This is an important definition for everybody because it tells you that generally accepted accounting principles are really nothing more than broad reporting guidelines. So let me just get the marker. Okay, so the GAAP standards are broad guidelines that represent the best alternatives out of many possible alternatives. And this is whether or not these are coming from the SEC, whether or not they're coming from the International Standards Board or the FASB. So GAAP. Broad guidelines, they're the best, what we consider the best alternatives out of many possible alternatives. Now, a couple of things to notice here is that GAAP, they're not necessarily hard and fast rules. We're giving guidelines to managers in making those decisions. So, for example, we tell you that if you buy a delivery truck for your business, you may have a delivery truck for that business, you have to depreciate the vehicle. We have a couple of different methods that we can use to depreciate. We also give you judgment. How many years is that truck going to last? I bet I would get at least 50 different responses. So I've got judgment and choice with respect to the method I'm going to use to depreciate it and the useful life, how long it's going to take me to use up that asset. And that kind of choice is what I mean by the broad guidelines. Now, what is best is going to change. It's the best method today. But, again, even if you're a financial manager in a corporation, you're going to find out that accounting standards change quite often. And you're going to have to adapt to those changes. By the way, it's very expensive to change an accounting standard because I have to retrain my employees. I have to, recreate a new accounting information system with a computer. So it's extremely expensive to change, but we do change those alternatives. And we do give different alternatives. And by the way, sometimes those alternatives will increase income, and sometimes those alternatives will reduce income. And when you look at these methods, it's going to tell you that it doesn't change the nature of the event. So I was watching, I guess, the Yankees the other night, and they're playing in Toronto. And I'm looking down the right field line, and I see it says 91 meters. If that was in Yankee Stadium, that might have been 320 feet. Is the distance the same? Yes. Is it measured differently? Yes. That's what accounting is. Accounting takes the same economic event and measures it differently. You could show higher income than me, but we could have the same transaction. We could buy the same asset and have different depreciation because we're measuring it differently. And that's what makes accounting, I think, important for everybody to understand that you need to know something about the process so that when you see the numbers, you can interpret them properly, either from a management decision-making or from the standpoint of a financial analyst. Could. Yeah, it could be measured differently from an accounting perspective. It is, yes, it is. Because what we but why do we give managers choices? The ideal situation. Now again, you're taking it from sort of a negative position, and you do have to be a little skeptical, but doesn't mean that everyone that works in finance or accounting should be walking around in handcuffs. It basically means that managers have choices to reflect what they believe are the best way for you to project their cash flow. Yeah, well, no, I mean, if I think that my earnings are going to go up in the future, I may be able to choose an accounting method that enables you to make that projection better. Not what? No, I mean, they're trying to ensure that someone could make the appropriate use of that information. Now, that's one way to look at it. The negative side is you're manipulating earnings. That's the negative side, which is somewhat the view, the typical view. Yeah, but it's not necessarily the only view. Now, let me ask you, while I have you, why would I want to purposely reduce income? I can select a method here that I could increase income. Income could go up, or income could go down. I could have method 1 or method A, which raises income. I could have method B, which reduces. I want to get the reducing first. That's a hard one. What do you got? Well, nothing to do with cash. Okay. Question. Everyone with their hand up, you going to say tax? Yeah. All right. That is true to about 1%. We have 2 sets of books, and that's why I asked the question, and I do want that answer because it's partially correct. The most important thing, I think, over the next 10, 15 minutes that we have, or 10 minutes that we have left, is that you have to understand that financial accounting, FASB, SEC rules, have very little, if anything, to do with taxation. You can show the government one set of books, and you can show your stockholders another set of books. We have what we call, I guess, 2 sets of books. It's actually more than 2 sets of books. You can show New Jersey, some numbers, New York State numbers, federal government numbers, and the stockholders' numbers. Taxation is partially true. There's a small link between that, but this is financial reporting, not tax accounting. Now, I could also lower income for a lot of reasons. One, I may not want to give you a raise, right? I may want to charge you more. Yeah, I may want to charge you more money to ride the subway. So I go to the New York City, and I could do that too. Why would I want to raise income? More people invest. Now, again, we watch, and you have to remember, I just want to make sure you know that income increasing, income reducing, this is not the Wild West. I mean, it's not like where you could do whatever you want, but you do have auditors to make sure that these are within reason. They're within reason. So you do get a auditor to review the numbers to make sure that they're a fair presentation. But as I said, you could pick a method of depreciation, and I could pick a different method. You could show more income than I show, depending on the method. So it doesn't mean that we're trying to manipulate, but you have to remember, and I'm glad we got into the discussion only because I wanted you to get to that tax question. So remember, there is a completely different set of rules for tax than there's going to be for book purposes. And again, remember also that you're going to wind up with a different set of rules for internal and external reporting. We're looking at external reporting for stockholders. Now, let me make sure, in way of summary, that we take a look at least some of the concepts that go behind this. And this is the FASB, and again, a couple of things to note here is, number one, that the FASB's been around since '73. What I want you to look at is the third bullet here, that the standards are now codified. It's almost like the IRS code. It's kind of put together now in a codification, and you have access to that. It's the accounting standards codification. And again, we try to give you as much information as possible that makes the information useful. And we hope that it's relevant to you when you make a decision and it's faithfully represented. Now, these are two concepts that you have to think about. When you think about something that's relevant, it's going to be useful in decision making, and as we said, it's got to be material. As I've been saying to you, you want to use it to make projections or predictive value and confirmatory value. So if you made a projection, let's say I used the quarterly report this year to project next year's earnings, I can look at the annual report and determine whether or not that projection is correct or incorrect. Analysts make forecasts of earnings. Those analysts can be correct or incorrect. Well, where do we find that out? We find that out from the financial information. And then faithful representation. To the extent possible, we want the information to be complete. We try to make it as neutral as possible, and we try to make it, as we said, free from material error. And, we did say that the generally accepted accounting principles are designed to meet those two, ingredients for useful information. Now, again, let me just go to the next slide for you to tell you that GAAP does change a lot, and different boards were around, so you don't have to memorize this just to be complete with the information today. Before the FASB, you had a Committee on Accounting Procedure, Accounting Principles Board. They're all the same. They're not government agencies. They're private boards. So again, these are not government agencies. So these were predecessors to the Financial Accounting Standards Board. Now, we're also going to look at, aside from the idea of relevance and faithful representation, let me go right here. These are some accounting assumptions that we're going to cover. Now, these are important. This is part of the theory. We talked about theory on exams. So these are some key principles that govern the information that we have. We have something known as a business or an economic unit or entity assumption, monetary unit, the cost principle, and the going concern concept. Now, when you look at the first one, this one again is something that, these are key points. So far, a couple of key points that we've mentioned. The tax versus the book, tax versus financial statements, the SEC. This is extremely important because you could be an accounting entity, but not a separate legal entity. For example, if I own my own business, I'm an individual and I'm a business. Legally, I'm not separate, but from an accounting standpoint, the business is a separate legal entity. So to define that more formally, I'll leave you with this. It tells you that the economic entity assumption tells us that the business has to be separate from the owner, even though legally I'm not separate. So if I started my own business and I call myself, ABC Company, if I do something, I'm responsible. I'm not separate from the business. But from an accounting perspective, I'm going to be separate and distinct from that business. So if I buy a car and I use the car for personal use, it doesn't go on the business. If I invest the car in the business, it goes on the business books. So the business entity or the economic entity says that the business has to be kept separate from the owners and from any other economic entity.